In this video, traders, we're going to look at the bear put spread. Perfect if you're moderately bearish on the underlying. Hey guys, warm welcome to you. So the bear put spread is something that you would trade if you are moderately bearish. So why moderately bearish, you might ask? Well, the advantage of this is that it costs you less than just a naked put option, but the disadvantage is that you cap your upside. So if you're moderately bearish, that doesn't matter, right? If you say, hey, I think it's going to go down a little bit, if you're right, then that's fine, because you don't need the unlimited upside that comes with the put option. You prefer to pay less for the deal and then make the money that way than having that unlimited upside on your profit, but paying more for the whole deal. So this is great for moderately bearish. If you think about a put option, you buy a put option, the put option is the right, but not the obligation to sell the underlying at a specific price at a specific point in time. So a July $50 put option gives you the right expiry in July to sell that stock at $50. So if it's trading at $10, are you gonna sell it? Of course you are. It's got $40 worth of value. If it's trading at $100, what's the value of something being able to sell it at $50 that's trading at $100? Worthless. Same with anything, guys. When you're buying a put option or buying a call option, your total risk is the amount you've paid for the option. So that's the same with this. So it's for moderately bearish traders. The features are, you've got capped downside as always when you're buying options, and you have capped upside. So capped upside means that you can't make an awful lot of money. There's a capped amount of money you can make on it, regardless if it goes massively against you, or sorry, massively downwards in the downside direction in the case of a put. So let's have a look at an example. This market, or this stock is XYZ, is currently trading at 38 bucks. You're moderately bearish. You want to construct a bear put spread. What you would do, one example here, you can construct this in any ways, and we'll have a look at that towards the end of the video, but you can buy a $40 put option, which gives you the right but not the obligation to sell this stock at 40. That's $2 in the money already. That's costing you $3. And then you sell one $35 put option, and that's cost $1, so you receive $1 back. So that's costing you $3 out. You receive $1 back because you're taking the other side of this deal. You're selling the $35 put, which means if it expires worthless, you make that dollar. But don't forget, you've bought $3. So the total cost of the deal, which is the best way of thinking about it, the deal cost, because these are all based on the same underlying, is $2 per contract. Okay, that's a total, and we call it a debit because it's costing you $2. Let's have a look at some scenarios and see how much you make on the deal if the stock went up, if the stock went down, if the stock did nothing. So first of all, we're trading at $38. Let's have a look and see what happens if we trade at $40. If we're trading at $40, what happens to the $40 put? You've got something that's the right to sell at $40. It's currently trading at $40. What's the value of that? Zip, zero. Unfortunately, you've lost your $3 on that one. How much about a $35 put? Well, again, unfortunately, you've got the right to sell something at 35 that's trading at 40. Again, that's of no value, so that's zero. But don't forget, you sold that, so you've made that one, which is good. But if you think about the total now, the total valuation of these is zero, but you paid $2 for it. So you've lost $2 on that deal. And if we just drill down into it a little bit closer, just think about this. That's worth that. You've lost 3 on that. You've made 1 on that. 3 minus 1 is 2. That's the total loss you've got. And you can see that however high the price goes, that's the same kind of thing, because the 40 put is still going to be worth 0 however much high you go above 40. It could be 400, it's still worthless, right? You got the right to sell something at 40 that's 400, it's worthless. The put as well is going to be worthless. You got the right to sell something at 35 that's currently trading at 400, that's got no value, and you sold that. Great, you're looking nicely on that one. Okay, so let's look at something that occurs and would make you a profit. So as this is moderately bearish, let's look at what happened if the stock would go down to $34. Okay, $34. So $34, what happens to the put? Great, the $40 put is worth $6 because that's the value of the contract, you're the right to sell something at 40, it's trading at 34, $6 in that one. But the 35 put, how's a 35 put? Well, the 35 put is worth $1 as well, right? Because you've got the right to sell something at 35 that's trading at 34. Unfortunately, you were selling that one, weren't you? You were selling that. So, you know, you're not looking so great there. You've lost money on that, but it doesn't matter because you've made money on the put. So we're looking at the total value of the whole deal. The total value of the whole deal is this: 6 minus 1 is 5, minus the 2 we've paid for it. So we get $3 profit on that. And you can see on this chart how that works. Regardless of how low the price now goes, this sum is still going to be the same, because what we make on one, we lose on the other. What we lose on one, we make on the other. That will then be in symmetry all the way down as the price goes to zero. So you're never going to make more than $3 on this, and that is capped at the price that you sell that put at. If you sell that lower, then the price, then the kind of capped level is going to be at whatever level that is. And the same with the downside risk. The downside risk is capped at the place that you buy that lower put, or sorry, so the higher put. Okay, let's have a look at maybe an extreme example, just to see what happens. $10, go to $10. Great, you know, it's really, really tanked this thing, and you kind of wish that you bought a naked put, but you didn't, because it cost you less. But regardless, you've made some money. Let's see what you've made. So at $10, a $40 put is worth what? It's going to be worth $30. You've got the right to sell something at 40. It's worth 10. That's a great deal. That's worth $30. What about a $35 put? Well, the $35 put again is going to have a value. The value of that's going to be $25, because the difference between $10 and 35 is 25. But you've lost that. You've lost that 25 because you're on the other side of the deal, don't forget, because you sold it. But you've made your 30, so your net is still 5. The same with this. Your net is still going to be 5 regardless, and you paid 2 for it, so that's good. You've made $3 on the deal. So you can see how, regardless of how low we go, that net will always be 5, and you've paid 2 for it, so you're making a profit of 3. And it's the same on the flip side as well. So that's a bear put spread, guys. Great if you're moderately bearish. You can see why, because you lower the price. If you're just buying an outright put, let's say you were buying that $40 put, you'd be paying $3 for it, but you've reduced your cost massively down to $2 by selling that 35 put at the expense, of course, of capping that upside. If we just look at very, very briefly, if we didn't have that 35 put, you know, let's say the $10 put, you'd be making an awful lot, because that would suddenly be $30. You pay $3 for it, you've made $27. That's a massive upside. So you would only do this if you're moderately bearish. If you think this stock is going to die a horrible death, then you want to be buying put options out of the money even. You know, you might even want to buy a 35 put at $1 and make even more if that thing goes to 10 percentage wise. So anyway, you go, guys. It's a bear put spread. Good if you're moderately bearish. Keep your risk managed, whatever you're doing. This is a good way of doing it. I'll see you next one. Bye-bye.